Well, when I was first asked to be a part of the panel, or even before that, when we were trying to figure out what the panel might be, it occurred to me that we needed to kind of ask the question, is tax reform ready for outside the Beltway? I remember back when I was in practice, and this was a long time ago, but there were many changes, if you can remember, in the late 70s and early 80s. And you were pretty much told not to worry about it until there was a proposal that you could actually anticipate getting in the way of the way a client was doing business, or was going to be change something that was on your desk, to wait till it's a little bit further along. And with so many things that are not normal about the political situation now, okay, which parts of the procedures that we are used to are people going to be using? Which parts of the old way approaches to scoring, whether they're the old or the new old, are any of them going to be implemented in the same way? It's my understanding that we still don't have some of the people in place in Treasury who would usually be involved in this kind of an effort. Given that, wait a minute, is tax reform real enough to be considered, if you will, outside the Beltway? And it's pretty clear to me that the answer is that it has to be. That if we've got a president willing to promise the biggest tax cut ever, and content to leave us not knowing who he's making that promise to, it behooves us to try to find out who he's making that promise to, and to figure out a little bit more about what our common goals in tax reform should be. And the more we discuss things outside the Beltway, whether it's getting down in the nitty-gritty of very novel but intricate proposals, or whether it's merely trying to figure out what, if we could measure the outcome, we would be happy with the outcome, we should be doing both of those kinds of things, both the very technical, whether it's legal or economic, and the more less fine-grained political. We really do need to engage. And one of the ways that I thought that I could engage was in the fact-checking exercise about what it would mean to have the largest tax cut ever. I despaired of there ever being an appropriate measure for what the largest tax cut ever would be, because the way a tax cut is scored and presented to the public does not always reflect what it actually does. And we just don't have very many numbers to tell us what any particular piece of tax legislation actually did, rather than what it was predicted to do. But I did stumble across one that I thought, I don't know which way this is going to go in the fact-checking, but when the Federalists' land tax was abandoned by Jefferson, who had in fact campaigned on the abandonment of this tax. There was a Federalist land tax. The federal government did collect a tax on real property, and they were booted out because of what it meant, not just in terms of the taxes that were paid, but the bureaucracy that it created and the vision of the federal government that would have been involved. When the Jeffersonians turned their back on this source of revenue, they were abandoning 20% of the then federal budget. That's what they wanted to do.
Charlotte, if we're talking about absolute dollars, the Boston Tea Party was a huge tax cut too.
But that was never a tax cut if you count what was being collected compared to what the change was. So again, we got some serious measurement problems when we try to do this. But meaningful tax reform is hard to get our brains around when everybody seems to have been promised a tax cut. You just can't do that, can you? Well, unfortunately, maybe we can pretend that we do. We have lots of instances in the last 10, 20 years, and maybe I've just been naive in the ones that, in the way I've approached federal tax legislation in the past, where Congress does things that, yeah, okay, we're going to get rid of cash-rich spins. Really? Did we get rid of cash-rich spins? I don't know that we did. With a Congress that's willing to pretend that it's doing things that it doesn't really do, I mean, maybe they can pull off something that looks like a tax cut for everyone. But I think we just have to take this whole process more seriously than letting Congress do that. And one of the ways that we need to do that, I think, is to realize that we actually have some serious limits in the way we can define tax bases. That as long as, what was the metaphor we were using last night? As long as we draw cartoons in the sky, particularly with the help of economists, and pretend that we have just printed a lithograph, right? As long as we imagine tax bases that are based on piles of paper in lawyers' offices, those partnership agreements, those LLC agreements, whatever they are, as long as we pretend that we have defined a tax base that never touches anything real, we're asking for trouble. Let me give you an example, another example from history. When the British first adopted the income tax in the turn of the 19th century, it was not because some economist had told them that it was principally the right thing to do. They adopted the income tax because the land tax, a tax that was more like our real property tax, couldn't collect any revenue because the matching of the value in the tax base with the source of cash just wasn't there. And the people who were supposed to be collecting it were in effect collecting it from themselves and their brothers and their cousins, and that didn't work either. So they went to the income tax because what the income tax was at that point in time was an interception of the revenues being paid by tenants to their landlords. There was a payment already being made. The income tax, when initially developed, was a diversion of those revenues. My point isn't that we should return to what Jefferson abandoned and adopt a federal land tax. My point is only that we have to make sure that when we define a tax base, particularly one that's been handed to us by economists, we've got to make sure that we can technically make it work. To give you a graphic example, and maybe this problem has been solved, and I'll retreat if it has been, but you can't have a tax that denies a deduction for imports and allows a deduction for domestic inputs without knowing what you mean by import. You have to come up with a technical way of distinguishing imports from everything else. And if you can't do that, if you can't put the idea of import into something that has some reality in the real world, right? It came off a ship. Right? You're asking for trouble in defining a tax base that relies so heavily, at least as I understand, it relies so heavily on the concept of import.
How about services? I mean, there are many questions about services.
Services, inputs
Where
from.
is the service?
I mean,
Is the service being imported or exported?
Mine was just the.
What about income from intangibles?
Well, we could go on and on, but we've got to recognize that we can't make those definitions be what the economists would want us to have them be and end up with an administrable system. Because what the economists and all of their equivalences would come up with doesn't describe very much in the real world. Now, mind you, I'm not telling you that we should abandon paying attention to what the economists say we're doing, right? Their analysis is critical, even if it ends up being indeterminate. We ought to have some notion of what we're doing, but when we rely on them too much for, oh, don't worry about that because it's the same thing as this, yeah, okay. They told us that Roth IRAs are the same as regular IRAs. Well, okay, that would have been true if the drafters had been more careful when they defined the limit in what a Roth IRA could, how much you could put into a Roth IRA. They didn't do that with any care, or I could be cynical enough to say they did it with so much care that nobody noticed that they did it wrong. But more importantly, it only works if nobody cheats. It only works if you can't put assets with supernormal returns into a Roth IRA. There are a lot of very famous people's tax returns that show that you can cheat on those, what you put into a Roth IRA, making them not anywhere near equivalent to a regular IRA. Okay? Maybe that was a cheap shot, that example, but there it is. I have one more comment, which is, you know what? There are going to be losers. Even if it looks like everybody's going to get a tax cut, there are going to be losers, and we got to manage the politics of the losers. And here I'm going to really be Pollyannish. You know what? Nobody has to do business in a pass-through. They may be doing a business in a pass-through now, but nobody has to do business in a pass-through. So if you don't like the idea that corporations are going to get taxed on their income at a 15% rate while you're still stuck at 35%, there's a solution. Put your assets back into a corporation where we can impose a tax that is administrable instead of letting the abomination that is now pass-through taxation continue. Eric, would you like to comment? I'm done.
You don't.